In September 1929, Irving Fisher, then widely regarded as America's most esteemed economist, addressed a gathering of investors. He delivered a pronouncement that would irrevocably shatter his professional standing. He declared, "Stock prices have reached what looks like a permanently high plateau. I do not feel there will be soon, if ever, a 50 or 60-point break from present levels." A mere 9 days later, the market catastrophically collapsed. Within 3 years, stock values had plummeted by an astonishing 89%. A quarter of all Americans found themselves jobless, and thousands of banks crumbled. The Great Depression had commenced. Irving Fisher was by no means a fool. On the contrary, he was a distinguished Yale professor, a mathematical prodigy, and the pioneering founder of modern monetary theory. Yet, he committed one critical, fatal error. He genuinely believed that this time was fundamentally different. He was convinced that the advent of new technologies, automobiles, radios, electricity, had ushered in an unprecedented and enduring era of prosperity. Consequently, he thought that the traditional rules governing valuations and debt no longer held sway, and that the market could only ever ascend. He was disastrously mistaken. Fast forward to 2025, and we are now hearing these same, chilling pronouncements. This time is different, they assert. AI has transformed everything. Productivity is exploding. The Fed has the situation completely under control. Stocks can only go up. The parallels between our current situation and that of 1929 are not merely subtle, they are screaming for attention. Margin debt has soared to all-time record highs, and we witness rampant asset bubbles across stocks, real estate, and cryptocurrencies. Overconfidence is so pervasive that any cautionary mention of risk is openly ridiculed. Most terrifying of all is the identical, delayed crash psychology, where every minor dip is bought and every clear warning is deliberately ignored. Everyone, it seems, firmly believes they will exit the market before it ultimately collapses. Over the next few minutes, we will meticulously examine these precise parallels between 1929 and 2025. We will explore why the crash psychology remains identical, identify the specific triggers both then and now, and outline a potential timeline for when this current situation might unravel. For while history may not repeat itself exactly, it certainly often rhymes. Let me begin by unveiling the true nature of 1929, as much of what you were taught in school is, in fact, inaccurate. You were likely instructed that the crash was sudden, unexpected, and seemingly appeared from nowhere. This is patently false. The unequivocal warning signs were evident everywhere. People simply chose to disregard them. The 1920s earned their moniker as the Roaring Twenties for a very good reason. Following the conclusion of World War I in 1918, America embarked upon a decade of extraordinary and explosive growth. Groundbreaking new technologies were rapidly transforming daily life. Motor cars, radios, refrigerators, and washing machines became commonplace. Productivity was skyrocketing, and corporate profits shattered records quarter after quarter. Unsurprisingly, the stock market enjoyed a relentless upward trajectory. Between 1921 and 1929, the Dow Jones Industrial Average surged from 63 to 381 points, a colossal 500% gain in just 8 years. The financial press of the era christened it the New Era, proclaiming that the old economic cycles were defunct and that technological innovation combined with modern management had forged an enduring era of prosperity. Sound rather familiar, doesn't it? However, beneath the surface of these optimistic headlines, something inherently dangerous was quietly accumulating: debt, and more specifically, margin debt. In the 1920s, one could purchase stocks with as little as a 10% down payment. This meant that with just $1,000, an investor could effectively control $10,000 worth of stock. If the stock appreciated by 10%, your initial investment effectively doubled. Conversely, if it declined by 10%, you lost everything. By 1929, margin debt had ballooned to an alarming $8.5 billion, representing nearly 10% of the entire U.S. GDP. Virtually everyone was borrowing heavily to acquire stocks. This wasn't genuine investing, it was pure gambling with borrowed capital. On September 3, 1929, the Dow Jones Industrial Average reached its zenith at 381 points. Irving Fisher made his infamous, permanently high plateau prediction just 2 days later, on September 5. Soon after, initial cracks began to emerge. Steel production started to decline, car sales were falling, and unemployment figures began to tick upwards. Despite these deteriorating fundamentals, the market continued its upward climb, buoyed by the widespread belief in the new era. This phenomenon encapsulates the essence of delayed crash psychology, when underlying economic fundamentals weaken, yet asset prices continue to rise, driven purely by market momentum and leveraged money rather than intrinsic value. On October 24, 1929, a day forever etched in history as Black Thursday, the Great Crash officially commenced. Margin calls were issued en masse, compelling those who had borrowed to purchase stocks to sell their holdings. This initial wave of selling triggered a torrent of further margin calls, leading to even more forced selling, a devastating, cascading collapse. Within a mere few hours, billions in wealth simply vanished. Yet, here is the crucial point to grasp. Most people initially believed it was merely a correction, a transient dip. President Herbert Hoover took to the radio, confidently assuring the nation, the fundamental business of the country is sound. Financial experts urged the public to buy the dip. Many heeded this advice, only to be utterly ruined, for this was no mere correction. It was the genesis of a catastrophic collapse that would persist for 3 harrowing years. By 1932, the Dow had plunged from its peak of 381 points to a dismal 41, an 89% erosion of value. This wasn't a decline over days, but a relentless, slow, grinding destruction of wealth that unfolded over years. Banks failed on an unprecedented scale. Approximately 9,000 banks, representing about 40% of all financial institutions in America, went under. The reason was clear. They had lent vast sums to stock speculators who, in the wake of the stock market's collapse, could not repay their loans. When the stocks plummeted, these loans defaulted, and the banks inevitably failed. Unemployment skyrocketed, reaching 25%. 1 in every 4 American workers found themselves unable to secure a job, not due to idleness, but because the jobs simply ceased to exist. Foreclosures exploded, leading countless individuals to lose their homes, their farms, and everything they owned. Shantytowns, grimly dubbed Hoovervilles, sprang up in every major city. The Great Depression endured for an entire decade, from 1929 to 1939, only truly ending when World War II compelled massive government spending. An entire generation was profoundly scarred by this experience, and they all posed the same question: how did we not foresee this coming? The painful answer is that they did see the warning signs. They just refused to believe them, convinced that this time was different. Now, let us turn our attention to 2025 and confront why the parallels are so profoundly terrifying. In 1929, margin debt constituted 10% of the GDP. Today, official margin debt in U.S. stock accounts stands at approximately $800 billion. As of late 2024, this equates to around 3% of GDP, ostensibly lower than the 1929 peak. However, here's the crucial caveat: this figure only accounts for official margin debt. It entirely excludes leveraged ETFs that employ 2x or 3x leverage, options trading, which is inherently leveraged and has surged to record levels, crypto trading on platforms offering 10x, 50x, or even 100x leverage, and the substantial private credit and shadow banking loans secured against portfolios. When all forms of leverage across the financial system are aggregated, we find ourselves at levels that either equal or surpass those seen in 1929. Retail investors, everyday individuals, are utilizing leverage like never before, driven by phenomena such as Robinhood trading, meme stocks, and the explosive growth in options. During the GameStop saga of 2021, for instance, retail investors poured billions into call options, a form of pure, implicit leverage, essentially borrowing to amplify potential gains. This reflects the exact same psychological mindset of 1929, the ingrained belief that stocks can only ever appreciate, thus making borrowing to buy them seem like free money. Margin debt famously spiked to an all-time record of $936 billion in 2021. While it has since receded to $800 billion, it undeniably remains at historically elevated levels. Every single previous peak in margin debt has invariably preceded a major market crash. The dot-com bubble in 2000, the 2007 financial crisis, and the meme stock peak of 2021. We are currently experiencing the third highest margin debt level in history. In 1929, the speculative bubble was predominantly concentrated within the stock market. Today, however, we are witnessing simultaneous bubbles inflating across multiple asset classes. The S&P 500 currently trades at a Shiller-P ratio of approximately 30, whereas its historical average stands at a more modest 16. This means stocks are presently valued at nearly double their long-term average. The only periods when valuations were higher were 1929, 2000, and 2021. Remarkably, we are at 1,929 levels right now. The Magnificent Seven tech stocks alone account for over 30% of the S&P 500's total market capitalization. This level of market concentration is unprecedented in history, save for the year 2000. Should these 7 behemoth stocks falter, the entire market is set to follow suit. Home prices, when measured against income, are currently at their highest recorded level, even surpassing the peak of the 2006 housing bubble. The median home price is an astonishing 7.5 times the median household income, significantly higher than the historical average of 3 to 4 times. Furthermore, Bitcoin, Ethereum, and thousands of other cryptocurrencies have spawned a market valued at over $2 trillion, possessing absolutely zero intrinsic value, generating no cash flows, and existing purely on the back of speculation. This is undeniably the everything bubble: stocks, housing, crypto, private equity, all simultaneously inflated. In contrast, 1929 contended with only a stock market bubble. Today, we have 4 major asset classes exhibiting undeniable bubble characteristics. Back in 1929, the prevailing narrative was that technology has changed everything. Cars, radios, and electricity were revolutionizing American life, productivity was soaring, and therefore, the old rules no longer applied. Today, the narrative is strikingly identical. AI has changed everything. We are entering a new era of unprecedented productivity. The old valuation models simply don't apply to these cutting-edge tech companies. This particular parallel is the most perilous because its danger is purely psychological. In 1929, anyone who dared to voice concerns about excessive valuations was dismissed as old-fashioned, as someone who simply failed to comprehend the new era. Today, if you issue similar warnings about current valuations, you are routinely told that you do not understand exponential growth or that you simply don't understand AI. The specific language may differ, but the underlying psychology is terrifyingly identical. Consider this direct quote from John J. Raskob, a prominent General Motors executive in 1929, "Everybody ought to be rich. A man who saves $15 a week and invests in good common stocks will be worth $80,000 in 20 years. Contrast this with today's ubiquitous crypto influencers who glibly proclaim, "Just buy Bitcoin and hold. You'll be rich in 10 years. It is the exact same spirit of overconfidence, the very same promise of effortless wealth. And this brings us to the most dangerous parallel of all, delayed crash psychology. In 1929, discernible warning signs had been flashing for months prior to the eventual crash. Steel production peaked in June 1929, a full 3 months before the market collapse. Car sales began to decline in early 1929. Building permits fell, and unemployment gradually ticked upwards. Yet, the stock market relentlessly continued its ascent. Why? Because of momentum, because everyone firmly believed that stocks only ever went up, and because every dip was enthusiastically bought. Today, we are witnessing precisely the same pattern unfold. Corporate earnings growth has demonstrably slowed. Consumer debt has reached all-time record highs, with credit card debt surpassing $1 trillion, student loans at $1.7 trillion, and auto loans also at record levels. Savings rates have collapsed to less than 4% of income. Yet, despite these fundamental weaknesses, the stock market remains near its all-time highs. This stark divergence between weakening fundamentals and escalating prices is the clearest possible warning sign. And just as in 1929, every market dip is being bought. Every minor correction is met with the ingrained by the dip mentality. The prevailing psychology is rooted in several dangerous mantras. The Fed won't let markets fall. Stocks only ever go up. You can't time the market, just stay invested. While these mantras may hold some truth in normal market conditions, they become a blueprint for financial suicide when you are ensnared within a speculative bubble. Because in 1929, those who bought the dip in October ultimately lost everything by 1932. The dip relentlessly kept dipping for 3 excruciating years. Let me now illustrate the precise mechanism by which the 1929 crash unfolded, as understanding this sequence provides invaluable insight into what we must watch for today. First, peak confidence in September 1929. Markets were at all-time highs, experts were confidently declaring a new era, margin debt had reached record levels, and a pervasive bullish sentiment gripped virtually everyone. Then, the crack on October 24th, Black Thursday. A seemingly minor piece of negative news, a decline in steel production, triggered an initial wave of selling. This initial selling, in turn, triggered margin calls, forcing those who had borrowed heavily to buy stocks to sell their holdings. Next, the cascade on 28th and October 29th. Forced selling begot more margin calls, which, in turn, instigated yet more forced selling. This created a relentless, self-reinforcing feedback loop. Panic quickly set in as everyone scrambled for the exits simultaneously, only to find a dearth of buyers. Prices entered a freefall. Following this, the rally in November. After the initial, violent crash, markets experienced a significant rebound, rallying by as much as 20%. Many believed the worst was over, and experts confidently declared that the bottom is in. People, unfortunately, bought back into the market. This, however, was the bull trap, the deadliest phase of all. Subsequently, the grinding decline from 1930 to 1932. The post-crash rally ultimately failed. Markets began to decline once more, but this time slowly, painfully, and relentlessly. This was not a single, dramatic crash, but rather a prolonged series of lower highs and lower lows that unfolded over several years. Anyone who had bought into the November rally ultimately lost everything. Finally, economic collapse from 1930 to 1933. The stock market collapse decimated wealth, which directly translated into reduced consumer spending. Less spending forced companies to shed workers, leading to a surge in unemployment. Rising unemployment, in turn, led to more loan defaults. Defaults triggered widespread bank failures, which then destroyed even more wealth. The devastating doom loop was complete. Based on the distinct patterns observed in 1929 and current market indicators, here is the most probable timeline for today's situation. Right now, 2025 peak overconfidence. Margin debt is dangerously elevated, valuations are extreme, and clear warning signs are appearing but are being steadfastly ignored. Markets continue to rise, driven purely by momentum. Sometime in 2025 to 2026, the crack happens. A trigger event occurs. This could manifest as a significant bank failure, a major geopolitical crisis, an inflation spike compelling the Fed to aggressively raise interest rates, a large corporate bankruptcy, or a debt ceiling crisis. Whatever the specific trigger, it will initiate an initial wave of selling. Margin calls will be issued, and the cascade will begin. 2026 to 2027, the crash and bull trap. Markets experience a rapid and sharp decline of 30 to 40%, followed by a deceptive rally of 15 to 20%. The media will declare that the bottom is in, and retail investors will buy back in, believing the worst is past. This is the perilous trap. From 2027 to 2029, the grinding decline. Markets fail to establish new highs and commence another period of slow, painful, and relentless decline. Unemployment begins to rise steadily, corporate bankruptcies accelerate, and the housing market crashes. Finally, 2029 to 2031, the bottom. Markets will have fallen by 60 to 70% from their peak. Unemployment will reach alarming levels of 15 to 20%. This period will necessitate massive government intervention. This timeline is not a precise prediction. Rather, it is a sober recognition of historical patterns. So, what actions should you be taking right now? First, reduce your equity exposure. If your portfolio is 100% invested in stocks, consider moving to a maximum of 50 to 60% in equities. The remaining 40 to 50% should be allocated to cash, short-term government treasuries, or gold. Second, eliminate all margin and leverage. If you are currently utilizing any borrowed money to invest, pay it off immediately. Margin debt is the primary mechanism that utterly destroys investors in a market crash. Third, hold significant cash reserves for the inevitable crash. When markets eventually fall by 60% or more, that is the opportune moment to buy, but only if you possess the necessary cash. Most investors, unfortunately, will be fully invested and entirely unable to capitalize on the bottom. Fourth, own some physical gold. During the devastating period of 1929 to 1933, gold was virtually the only asset that successfully retained its value. While stocks plummeted by 89%, gold remained remarkably constant. Fifth, prepare for potential unemployment. Ensure you have at least 6 to 12 months' worth of living expenses saved. The Great Depression rendered 25% of the workforce jobless, and nobody ever believed it would happen to them. And finally, do not attempt to time the exact market top. You will almost certainly fail. No one ever truly achieves it. Instead, simply reduce your overall risk now, while market conditions still appear relatively stable. It is always far better to be a year too early than a single day too late. In September 1929, Irving Fisher famously declared that stocks had reached a permanently high plateau. 9 days later, the catastrophic crash began. He ultimately lost his entire fortune, died in relative poverty, and dedicated the remainder of his life grappling with how he could have been so profoundly mistaken. He was wrong because he genuinely believed that this time was different, that technology had fundamentally altered everything, and that the old economic rules no longer applied. He was wrong because he mistook a liquidity-driven speculative bubble for genuine, sustainable value creation. Crucially, he was wrong because everyone around him was echoing the same sentiment, thereby creating an inescapable echo chamber of extreme overconfidence. Here in 2025, we are hearing the exact same words. This time is different. AI changes everything. The Fed has our back. Stocks only go up. The levels of leverage are the same. The pervasive overconfidence is the same. The insidious delayed crash psychology is precisely the same. The only remaining variable is timing. The 1929 crash was not triggered by a specific piece of exceptionally bad news. It occurred because the entire system was so excessively leveraged, so grossly overvalued, and so inherently fragile that any seemingly minor piece of negative news could trigger the devastating cascade. We find ourselves in an identical predicament today. The system is fragile. Leverage is extreme. Valuations are absurd. Any trigger and it will go. You cannot possibly predict the precise trigger. You can only prepare yourself for the inevitable cascade. The Great Depression taught us a harrowing lesson. Markets can indeed fall by 89%. Crashes can endure for years, not mere days. Buying the dip can utterly destroy you if you act prematurely. And critically, the individuals who ultimately survive and prosper are those who proactively reduce their risk before the danger becomes painfully obvious. In 1929, they insisted it was different. It wasn't. In 2025, they are repeating the same refrain. It isn't. The pattern is a century old, and it is on the cusp of repeating itself once more. If this analysis has shifted your perspective on 2025, I urge you to subscribe immediately. The next video will meticulously break down precisely which sectors are likely to crash first, which assets to strategically acquire at the bottom, and the specific signs that will unequivocally signal the commencement of the cascade. The Great Depression 2.0 is not a prediction. It is a discernible pattern. And patterns, historically, do not lie.